In this example, we are going to look at another bond issue, only this time when we calculate interest, instead of using the straight line method, we're going to use the effective interest method. So on March 1st, 2014, Muncie Corporation issued $1.2 million of 6% 5-year bonds. The semi-annual interest payment dates are February 28th and August 31st. Because the market rate for similar investments was 7%, the bonds had to be issued at a discount. The discount on the issuance of the bonds was $49,900. Okay, so just let's point out some of the information. We have our bond issue of $1.2 million, and our face interest rate is 6%, and we pay semi-annual interest payments in their 5-year bonds. So we're looking at 10 interest payments, 5 years times 2 times a year. Also, it mentions the market interest rate, and we haven't really paid a lot of attention to the market interest rate, but it is important now, which is why I have tried to illustrate the face rate. So the face rate of 6% is always used to calculate the amount of cash paid out in interest, and the 7% we're going to have to begin using now. So it says that the market rate for similar investments is 7%. So what that means is someone could go and get an investment very similar to the one we're looking at here, and they can earn 7%, but we're only paying 6%. So what we have to do in order to get people to invest in ours and to buy our bonds is offer them a little bit of a discount, basically kind of put them on sale. So what it doesn't show you here, it doesn't say, well, it's issued at 95 or 98, but what it is telling you, it's already giving you that amount. It calculated it for you. It says that the discount on the issuance of the bonds is $49,900. So here's what we're going to do to record our issue. So the cash received, instead of taking 1.2 million times 0.98 or something like that, it already gives us the $49,900. So the cash received will be the 1.2 million minus the $49,900. The unamortized bond discount amount is the $49,900. And as always, bonds payable is for the face value of the 1.2 million. So here's what your journal entry would look like. We debit cash because we're going to collect $1,150,100, and then we're going to debit our unamortized bond discount for $49,900, and then credit our bonds payable for $1.2 million. So that's not any different between one method or the next. What changes between the straight line method and the effective interest method is how we calculate our bond interest expense. So let's take a look at that. So I've gone ahead and put everything up here, but we're going to go through and we're going to explain each of these pieces. So what you should hopefully know by now is that when we have a bond discount, when we pay interest, we're going to debit bond interest expense, credit unamortized bond discount, and credit cash. What's going to change is how we calculate bond interest expense. I'm going to start with cash. That has not changed. How we calculate cash paid in interest right here. Cash paid in interest, face value, which is our 1.2 million, times our face rate, which is 6%, times 6 over 12, or divided by 2, gives us the $36,000 that's going to be paid out in interest. Now that calculation holds true whether it's a straight line method or the effective interest method. What changes now is our bond interest expense. So for bond interest expense, we're going to take our carrying value, which we're going to talk about, times our market rate, which it says our market rate is now 7%, times 6 over 12. So we're not calculating the unamortized bond discount account first. We have to calculate the bond interest expense first. So the carrying value is always going to be, for your first time you're going to pay interest, it's going to be the amount of cash that you received, because carrying value is going to be our bonds payable minus our unamortized bond discount amount. I haven't heard him saying that today. Okay, so if you were to take the 1.2 million minus the 49,900, our carrying value would be the 1,150,100. So to calculate bond interest expense, we take 1,150,100 times our market rate of 7% times 6 over 12, which gives us the 40,254. So that's the amount that goes to bond interest expense, and then the difference of the bond interest expense and the cash is what we credit our unamortized bond discount account for. The other thing that's going to change, we're going to calculate our second interest payment, but it doesn't stay the same. These amounts are going to change. The only amount that stays the same is the cash. So let's take a look. Okay, so you can see the account we're going to debit and the accounts we're going to credit stay the same, and the calculation of cash remains the same. But we need to recalculate our bond interest expense because it is based on the carrying value, and the carrying value will change because the balance of our unamortized bond discount account will change. So our new carrying value is going to be our previous carrying value plus the amount that we credited to our unamortized bond discount. Now I just want to say that we are dealing with the discount. In a premium, you would minus here because the goal here is to get our carrying value to equal our face value amount in the end. So in order to get 1,150,100 to equal 1.2 million, we're always going to have to add the amount that we amortized in the previous interest payment. So this becomes our new carrying value times our 0.07 times our 6/12 gives us a bond interest expense of $40,402, and then the amount that goes to our unamortized bond discount will be the $4,402. Now if we were to continue, what would happen in the next one is our carrying value would now become this plus the 4,402. So each time we take our previous carrying value and we add our previous unamortized bond discount amount. And so again, just as a disclaimer, I want to make sure you know that we only add when we're doing a discount. If this were be a premium, we would subtract.